Hello and welcome to this very special Independence Day special show on financial literature, on financial independence that one can achieve. And just as the first light of dawn holds the promise of a new day, Shrishti, early investments also hold the promise of a brighter financial future. And in this show, Shrishi Sharma and myself, Cheryl D'Souza, will unravel the secret of identifying opportunities before they bloom and explore the art of nurturing investments that stand the test of time. From stocks to debt, real estate to rare finds, we'll embark on a voyage that demonstrates how not the early bird, or rather how the early bird not only catches the worm but also cultivates a garden of abundance. And this is what you call the power of compounding, Shrishti.
Well, yes, absolutely, Cheryl. And this is in this special edition of the Independence Day. And to take us through the 30 minutes of learning, we are being joined by seasonal experts who have mastered the art of seeing what lies beyond the horizon. We are being joined by Feroze Azeez, Deputy CEO at Anand Rathi Private Wealth Management, as well as Neeraj Choksi is also on the show. He is a managing partner at NJ Group and Kalpen Parekh, MD and CEO at DSP Investment Managers. A very good afternoon to all three of you, gentlemen, and thank you so much for your time to ET Now. In this special edition, we're going to be talking about how early can one start when it comes to getting or rather targeting to achieve the financial independence, as well as what sort of an asset allocation one can start with. So let's get started. And Feroze, coming to you, and wanted to just understand from you that how power of compounding have you seen working wonders, and if one has to get all the benefits, or rather enjoy or rather witness the eighth wonder of the world, then how early can one start?
Good afternoon. Like you rightly said, that power of compounding is a very, very important tool, and that's rightly called the eighth wonder of the world. Having said which, I think as an Indian household, the problem lies in not just starting early, because we as a society have always saved a lot more than the most emerged economies. Like in the US, I was speaking to somebody who runs an NBFC. He says people take loans for a holiday which has an EMI of 7-8 years. So we are, as an Indian society, great savers. It's about starting early with equity investments, which is where the problem is. Last 10 years back, the household savings in India were 270 lakh crores. Now, in just about 10 years, the household savings, give or take, is 670 lakh crores. It is not just about the saving, it's about the investing right. Today, we have just about 7% invested in equity mutual funds out of the financial assets. Out of the total assets, we have just 4%. We have more money in currency or savings accounts and current accounts than we have in equity mutual funds. So, first point I'm trying to make is compounding works beautiful in equity, not in debt as much. Let me give you an example. If you look at 5-year to 20-year, now let's assume that if you invest money at a recurring frequency of 1 month, 5,000 rupees, you would accumulate at 7%, 3,57,000 at the end of 5 years. In 20 years, you will accumulate 26 lakhs. The difference, or the power of compounding, is 22 lakhs for the 15-year period, which is extra. But now if the return is not 7%, but if it is 15%, which is what equity has the potential to give you, in 5 years, you will get to 4.4 lakhs. But in 20 years, you will get to 74 lakhs. So the difference, which is nothing but the power of compounding, in equity for the same period was 70 lakhs. In debt, power of compounding was 22 lakhs. So when can one start? He or she has to start saving very early and invest in the right asset class. Power of compounding is not such a great friend for debt investment, is the larger point which I'm trying to make.
All right, so that's the point coming in from Feroze on the fact that power of compounding works well when it's equity investment and not in the other asset classes like debt. Good afternoon, Mr. Choksi. Thanks so much for joining us. Let me take forward the point. So given the fact the power of compounding works well when you invest that money in equity, but as young professionals, they don't have enough resources when it comes to actually starting early and investing early in the equity markets. What can they do? How should they actually benefit from the power of compounding, or at least actually multiplying their investments?
Thank you first for inviting me. I think it is very, very important that if you look at the formula of power of compounding, it says that amount or the wealth which is created is savings multiplied by the 1 plus rate to the power of n. Now, n is the exponent, and that is the most rewarding thing which I continue to believe. Even if you look at Warren Buffett's wealth, 80% of his wealth in his 50-year investing career came in the last 10 years. So even if the amount is small, even if an SIP of 1,000 or 2,000 or 5,000, if someone starts saving at a very early age before going to the college, probably when one is in the higher secondary or in the secondary class, if you start educating them about savings, I think to create wealth, three components are important. The more you save, the more wealth is created. If you invest in the right asset class, and equity is the only asset class which gives real returns over long periods of time. And the most deadly of that is N, that is the number of years of your investments. So I continue to believe that this is the thing which one needs to explain. And probably the current, I mean, the generation, we have to explain them about patience, that you cannot get money overnight. People are very, very interested in putting money in Bitcoins. If they have money to put in Bitcoins, or if they can play on Dream 11, then why can't they invest in SIPs? I think it is the duty of the entire industry to educate them rightly and make them a habit of savings and in the right asset class for long periods of time. That is what I feel. And yes, definitely power of compounding is the eighth wonder of world. There are n number of calculations for that. But I'll just share one statistics, that if you look at the mutual fund industry in India, in last 25 years, 38 schemes has given a return of 18%. So 1 lakh has become actually 70 lakhs. 70 times growth they have given in the last 20, and this is the average of 25 schemes I'm talking. Now there would have been ups and downs in this journey of 1 lakh to 70 lakhs, but if someone who had invested and stayed invested, probably this is the kind of return he would have made. And a 10,000 rupees SIP on an average would have become 3.6 crores. That is the data which we have. Yeah, thank you.
Stats to encourage all our viewers. But Mr. Parekh, coming to you, because Mr. Choksi was just touching upon Warren Buffett, where he started his investment journey at a tender age of 11, and he was 14 when he made his first real estate investment. And real estate plays an important role when it comes to the asset allocation. But Mr. Parekh, in India, when we see people investing in real estate, they don't talk in percentage terms. They generally, I hear people saying that their initial investment was 2x, 3x rather. So what are your views on real estate investments, and how can one actually reap the benefits of compounding in that front? And in the portfolio, what sort of an allocation would you be looking at for real estate?
Yeah, I think I'm the wrong person to ask about real estate, because when I started my investing journey, I was fortunate to be a part of the fund industry. So my first salary itself went in a mutual fund at an early age of 22. Actually, in hindsight, 22 is not early. And I started with mutual funds. And, rightly, as you said, at that age, you don't have enough money to invest in real estate. See, at least in a mutual fund with 500 and 1,000 rupees also every month, you can save. But in real estate, you cannot start investing. You have to actually borrow money first to start investing in real estate. Secondly, I bought my, first meaningful home only last year at an age of 48, 49. So my whole logic was that, tax-free compounding is very superior in financial instruments in India, and particularly within that mutual funds. Neeraj and Feroze both gave very powerful statistics. I give you my own example. I had a small home picked up in 2001 or 2 when I was just getting married. My father said that if you don't buy this home, I will not let you marry. And I sold it finally last year after 18 months of struggle. So real estate has illiquidity, it has tax inefficiency. And after everything, in an expensive city like Mumbai, it would have gone up by around 9 or 10 times. But in the same 20-25 year period, Nifty itself has gone up between 20 to 25 times. time. So I think overall equity markets, allow compounding at far lower cost, at far higher tax efficiency, and you have liquidity and convenience. You press a button, you can invest. You press a button, you can take money out. So personally, I have invested nothing in real estate except for my home now, and I think I'm very happy with the compounding. Secondly, you mentioned about Warren Buffett investing at 11. He added one more comment. When he said that I started investing at the age of 11. However, I repent that I started 11 years late. So I think it is the responsibility of parents actually to start early investing on behalf of their children, and also guide them and teach them the rules of investing, so that as they grow, they can embrace and start doing this at an early age, so that you are letting time play a very important role in the journey. Thanks.
And starting early is always better. And you were saying that 22, when you started investing, also was not early enough. But I want to stretch upon that point, the fact that now if you're looking to invest early, which method of investing in the equities do you think makes sense? Timely or time-based SIP makes sense at an early age, or should one go for lump sum investment as and when they have the funds for it?
Most Indians, and when we look at our own industry, there are around 3 crore investors. 90% of us earn our income. We get our cash flows only in a monthly manner. We don't get money, in lump sum. So because our inflows are monthly, automatically SIP becomes a very preferred mechanism of investing. Number two, even otherwise, if let's say over the last 25 years, if Nifty itself has gone up 25 times, some of our active funds have gone up 80 to 100 times. It's not been a one-way journey. There are 30% of times when NAVs fall. There are 30% of times when NAVs rise. And there are 40% of times where they very painfully go nowhere and they frustrate us. Now, the beauty of SIP is that it continues to invest in all these periods. And, 100 minus the 30% of times when it goes up, the balance 70% when it is painfully going down or going nowhere, if left to ourselves, we would actually, as human beings, stop investing because, we like rising markets. That is our behavioral, design. So an SIP overcomes this behavioral design or this lacuna, and even without asking us, every month goes and keeps acquiring units. So I have started investing for my son when, he turned 10 on his date of birth. So I call it a birthday SIP. So that, in his mind, the wiring for him is that every month on the 10th, there are some units which are going to come into his account, independent of any human intervention or action required. So I think SIP is like an automated way of investing, and any automated way of investing acquires more units when markets fall. And that, I think, is the beauty of SIP. It helps you add more units and, behave like how we behave when there is a sale. 15th August tomorrow, there will be many online sale programs going on, and we will go and actually spend money. So my thinking that I teach my son and I tell everyone is that our mindset should be to become a collector of units, to buy more units when NAVs are lower, and to keep doing that every month, regardless of market direction. And I think that has really reaped a lot of rewards for our industry as well as for our investors.
So that's the wise advice coming in from Kalpen, that how can one start investing and how to reap the benefits of the same. And but Feroze, you were just touching upon that if you want to get the benefits of compounding, start in equities. But a lot of people, because of the volatile nature of the markets, they tend to take their hands off and rather go the SIP way. But one, if has to start right now, and the whole idea of doing this special show is that how can we help our viewers in order to plan in a better fashion so that they can achieve financial independence. So at this point in time, if one has to make a portfolio, then what sort of an asset allocation will that look like?
I think, of course, asset allocation is reasonably specific to a person, an individual. But I think if you have periods of 5, 7, 8 years, I don't see a reason why you would not have more than 60, 70% in equity. As long as an investor, you're ready to accept the fact that the nature of the beast, which is equity, is that it will show you peak to trough. Every single year, it has fallen 14.3%. For the last 22 years, if you see peak to trough, Remove the two exaggerated years of 2008 and 2020 because of global financial crisis and COVID. Rest of the years average peak to trough is 14%. So if as long as you're able to internalize this uncertainty, and that's the precise reason why you are able to make more than FD, twice more, thrice more, is because of the uncertainty. So as long as you can accept it, you can start and have a 60-70% allocation to equity, more the merrier. And if you are able to hold for 7, 8, 10 years, it's very unlikely that you will underperform a small savings schemes or any debt instrument for that matter. That's point two. Point three, if you're at the age of 25, 27, 30, you should have at least 80% in equity. And real estate, to my mind, investment real estate should be zero. Invested real estate, consumption real estate could be whatever, but that's not a part of your balance sheet. Anything which you live in is not a part of your balance sheet. So if you want to buy a home to live in, there's no better way to spend money for the emotional comfort. But investment-based real estate is not a good idea. I would give zero to it because I have just analyzed, and for this financial year, we have analyzed 272 properties. We found out the IRRs of those. The IRRs were 8.1%. Holding period was 9 years, and still 8.1%. 0.5% more than Government of India. So no real estate investment. Debt could be 10, 20, 30%. And 60-70% in equity. In the same India will do very well for the next 10 years. You will find portfolios which don't do well, and there are portfolios which will do well. What will distinguish them is the courage to have an asset allocation which is towards the growth asset of equity.
So that's the asset allocation as per Feroze, believes that no money should be allocated to investment-based real estate, debt 10 to 20%, and talking about equity, definitely that gets a big thumbs up. Actually, from all of our panelists, 70 to 80% is the investment in equities is what Feroze actually advises. But Mr. Choksi, what about people who are risk averse? You have a lot of them who are not actually entering the market because they are pretty risk averse, not comfortable taking risks in the market. How do they achieve their financial independence? Do you think that the fixed income investments is better? Do you think for them FDs is better? What should they do, especially those who are risk averse?
The larger risk is of not taking risk, right? So when an investor wants to satisfy his dreams, his goals, aspirations, I think if you are investing in that at most periods of time, your return is in line with the inflation. In only a few periods, it is slightly higher than the inflation. Sometimes it is lower than the inflation also. So if you want to really create wealth, increase your purchasing power, equity is the choice. And I think one has to understand, one has to take that risk, one has to take that ride. But I mean, that is a very, very good ride. I mean, the kind of result you get after a long period of time is very important. So it is the role of an intermediary who has to explain the investor that, yes, this is such a temporary thing which happens. This is the way in which the market works. But over long periods of time, if you see whether it is US, whether it is UK, whether it is any market, over long periods of time, equity delivers real returns. And when you get real returns, I think your wealth get created, your dreams get satisfied. If you are a very wealthy investor and you don't need any wealth creation for satisfying your dreams and goals, then probably one can still continue with that. But I can give you a very simple example that if equity doesn't give a higher return than debt, I mean, your debt is also risky. If you're putting a money in a bank, and if the bank is not earning more than what they are giving to their deposit holders, then obviously, how is your deposit money safe? Right? And if they are lending it at a higher rate, and the persons to whom they are lending, if they are returning back their money, then obviously the stock will deliver a better return than the deposit. So I continue to believe that over long periods of time, one has to change the horizon. I think if your money is for short term, definitely one should not put in equity. But if the money is for long term, there are so many evidences, so many such experiences we have and such a beautiful data is there. In Indian markets, we have the data now. So obviously, if you explain them, and that is why today, if you look at the SIP collections, now the industry is about 15,000 crores and it is growing at a good pace. So I feel, and most important is that when markets are falling down, that is the time where the intermediary should come and explain and give comfort to the customer. Answer all his queries. Tell him that this is not the first time this has happened. This is going to happen, but we will have to live with it, and we will have to continue. It is the time, I think, in the market that matters. So if you give time, I'm sure the result will come.
What it matters in the market, and when the markets are falling, all of our panelists believe that one should definitely go big in that. But Kalpen, since you have been investing since the age of 22, and especially all our panelists have such a rich experience, but just wanted to understand from you, since you have seen so many cycles now, going ahead from now, because all of our experts are vouching for equities, what sort of a return expectation one can have from equities on a per year or a CAGR basis, and if one is investing through the SIP route, what sort of an expectation should they continue their SIPs with?
Firstly, next time please ask questions to me before Mr. Neeraj, because he takes away all the answers that I have written down. So I have to think on my toes now. And coming back, I linked my answer to the earlier question also. We were just doing this study and you had mentioned that people are risk averse, then what should they do? So the mutual fund industry is not only about equity fund. In fact, there are very well-designed hybrid funds and multi-asset allocation funds where you get a combination of equities and bonds as well as gold. And over a 20-year period, a combination of debt, equity, and gold would have given around 1 to 1.5% lower than equity, but probably 2 to 3% higher than fixed income at slightly lower volatility or meaningfully lower volatility. So investors can, learn about these ideas, and most investors don't have the wherewithal or the bandwidth to learn, and that's where having a good, advisor to guide them and coach them becomes important. Now, 22 years back when I started my career, Indian markets were not that well developed. We were not getting 15,000 crores of SIP inflows. Our market was at a P multiple of 10, 11, and 12, half of what it is today. Now, in these 20 years, average returns have been around 16 to 18%. Mostly, future returns are generally unpredictable. I cannot predict these returns, but a very simple way to look about it is that whatever is the return on equity of the companies at large in which we invest, over a long period of time, the returns that we would earn is closer to the return on equity that the underlying market offers. So in India, the return on equity for corporate India varies from 12% to 20%. At its best, it goes to 20%, and at on a normal ordinary basis, it is somewhere around 13 to 14%, which is where we are right now. So I think roughly the band of 10 to 15% is how I think about when I make my investments. That if all goes well, I would earn maybe 14 to 15%. And if let's say 20 years from now, when I want to take my money out and for some reason markets are in a down cycle, it can happen, right? Everything doesn't have to be rosy all the time. Maybe I'll earn 9 to 10% return. The worst case return, Feroze mentioned, the peak to trough ratio annually. But if you take the peak to trough ratio over long cycles also, imagine you had invested in 93, boom of Harshad Mehta period, 2000 boom of global tech bubble, 2008 bubble of global markets and in India. And from that day till today, whether 15 years, 20 years or 30 years have passed, the worst case return has been around 9%. So my view is that today if I invest in bonds, long-term return would be around 7%. My worst case return could be 2 to 3% more than bonds. If let's say I'm investing today and I get out 20 years from now when the market is in a bear cycle. So that's also good compensation. Right. And the last comment I want to make is in the movie Sarkar, Amitabh has a dialogue that नजदीकी फायदा देखने से पहले दूर का नुकसान ध्यान में रखना चाहिए. So what happens, typically what equity markets gives us is volatility. It's not risk. the risk is actually not investing and losing purchasing power. We are a country with 5 to 8% inflation. Every year, the value of our money keeps going down. So not investing is a much bigger risk. The comfort of short-term safety actually, blinds us to the long-term risk that we have if we do not increase our purchasing power. So I think these are few things to keep in mind.
Absolutely. And the biggest takeaway definitely is the fact that the biggest risk is actually not investing and not taking the risk in the financial market. Always one must keep in mind that financial independence is a journey, it's not a destination. So one must keep learning, keep going, and also making choices that align with their goals, isn't it, Shrishti?
Well, yes, absolutely, Cheryl. And but with this, thank you so much, Feroze, Neeraj, and Kalpen for joining us. But until we meet again, remember, viewers, that your financial independence is within reach, and you have the power to make it a reality. With this, it's a goodbye from me and Cheryl and the entire team who put this show together. Thank you so much for watching.